welcome to this wonderful webinar with Susan Lupton, the Senior Policy Associate at the Center for Responsible Lending. This is such an important time with the issue of payday lending, and she is such an expert, and she is going to tell you what is happening to end payday lending and what we in our roles can help to do about what's going on. And for those of you who are new to financial social work, I just want to familiarize you with what we do and why it matters. We know that our client's relationship with money and with him or herself is the key to financial behavioral change and to personal and financial growth. And it establishes the foundation for client financial behavior. And financial behavior is how we earn, spend, save, share, and borrow. And those behaviors determine our financial circumstances and our clients' financial circumstances. It's as easy and simple and as complicated as all of this. So we know that dollars and cents don't make financial choices. It is our inner money self. We all have one. And if we had some extra time, I would ask you to spend a minute acquainting yourself with your inner money self. But we have so much to learn about today that I'm just going to keep on going, point out to you that financial circumstances originate from within the money self. It's the money self, and we include our thoughts, feelings, and actions with your money and with yourself. It is that piece, that relationship that makes the work of financial social work unique, but it also makes it possible for our clients to increase their financial well-being. So we talk about inner money self, but an important component of this, we said your relationship with your money and with yourself. So we are talking about how your relationship with your money and with yourself interact, and why that's such an important component of financial well-being, increasing self-awareness, self-sufficiency, feelings of self-worth. And of course, we are a behavioral model. So financial behavioral change is what we're talking about. Financial well-being requires a healthier money self. Someone with a healthier money self just engages more readily, is more hopeful, is more eager to change, and more prepared to succeed. And all of these pieces matter. So we address here at our work at the Center for Financial Social Work, we do address the dollars and cents. We have to. It's an important component. But we also address all of these other pieces: hope, positivity, inner strength. And we put those together to make sure that our clients have the skills and the tools to increase their financial wellness. And those of you who join us regularly know how important this graphic is to me, because it represents being at peace with your money. So a quick overview of our model. It is ongoing and highly experiential. We provide financial education, motivation, validation, and support. This behavioral model is interactive, introspective, and strengths-based. It's used individually and with groups, and many financial therapists practice financial social work. So now to the really valuable and important work of our guest speaker, Susan Lupton. I am going to turn the presentation over to her and let her introduce herself to you, because I kind of rushed through that. Do you have it, Susan?
I do. Can you see my screen?
I can now. Terrific. Go ahead.
Great. Yay, that's good. Step one. So Rita, thank you so much for your introduction, and thank you to all of you who have called in to the webinar. I really appreciate you taking the time to join us. As Rita said, I work for the Center for Responsible Lending, and we are a research, policy, and advocacy organization that focuses exclusively on predatory lending issues. We have worked on a variety of lending issues: mortgage lending, credit cards, overdraft, and other abusive bank fees, student loans, debt collection, and of course the issue that we're talking about today, which has to do with payday lending and other forms of high-cost lending. I am based in our office in Durham, North Carolina, which is our main office for the Center for Responsible Lending, but we also have an office in Washington, D.C., as well as Oakland, California. So today we want to talk mostly about what's going on at the federal level to rein in payday lending abuses. And ironically, when we scheduled this webinar, which we did several months ago, we had absolutely every expectation that a final federal rule would be out on payday lending. That is not the case. It has not been released. So I needed to, Rita and I talked about this. The only thing we could do other than going ahead today without the final rule was to delay this till November, and we decided it was better to go ahead today and talk about what we know about the final rule and how that's going to impact people across the country. So we are going ahead. And for those of you who don't know, the rule we're talking about is from the federal agency called the Consumer Financial Protection Bureau, usually referred to as CFPB or the Bureau. I know those of you that are familiar with Rita have heard about this agency quite a bit, but it was created after the financial crisis in 2008 and charged with making sure that financial products are safe and appropriate for consumers. Federal regulators in the past had looked at whether financial products, how they affected the safety and soundness of the financial institution. But unfortunately, some products that are really good for the lender are not good for the consumer. And this agency looks at the other half of that equation. So we'll look at what the CFPB proposed for their proposed payday rule. What do we like? What didn't we like? I'm going to talk a little bit about what we expect from the final rule, which we do expect to be significantly different in some respects from the proposed rule. I'm going to talk about what payday lenders are going to try to do to get around this rule and how it will affect each of us all across the country in our various states, and also what each of us can do to get involved in defending the rule and defending the CFPB as well. I did want to start with a few slides that talk about the cost of and the abuses associated with really payday lending as well as car title lending. I just always feel like it's important to remind ourselves what these products really look like. And for some of you, you've never had these products in your state. You've been payday and car title free throughout this whole time. So this will be, you're not as familiar with the products. So typically for payday loan, the loans have been on average about $350. They can certainly be bigger or smaller, but that's an average loan size. And an average annual percentage rate is 391%, extraordinarily expensive, as you can see. And the loans are secured by someone's personal check. So, and usually due back in a 2-week cycle on the next payday. The graphic there shows that, the dilemma with payday loans is, of course, you get the first loan, You get your paycheck, the payday lender takes their money out of your bank account. You're short, you don't have enough money to make it to your next paycheck, so you go back and borrow again. It's actually a very confusing cycle for the borrower because you're always, it feels like you're putting new money in your pocket every payday from the payday lender, or quote unquote getting your money early, as some people have referred to it. But the reality is that the only time you're really getting new money is on your first loan. After that, you're just borrowing back your own money minus the fee. So if you took out a loan for $350, for instance, you wrote your check for $350, when you go back the next time, you're going to get $300. They're going to keep $50. So, you write a check for $350, you only get $300. You write a check for $350, you only get $300. So each time, and after the first one, you basically, borrowing back your own money minus the fee. And if you get caught in multiple payday loans, which a lot of people do from multiple lenders, you can just multiply this problem many, many times over. So it's extremely clear from the structure of the loan and also from the business model and what we know from lender information that these loans are designed to trap the borrower in debt. That is the intention of the loan. If they wanted to make a loan that you could afford to repay, they would not structure it this way. So they have made a loan that you can't repay to force you to come back over and over again. And the chart that's on the right of this slide is from Ace Cash Express. This is actually in their training manual, how you get the customer to come back over and over again. And since the payday lender is in a unique situation of having direct access to your bank account by holding your personal check, they get their money first. So when your paycheck comes, they pull out your money before you can even get your money, and you're stuck with whatever is left after that. And the consequences of having less money are dramatic, overdraft and bounce check fees, falling behind on other bills. A lot of people lose their bank account because they're behind so often. Some people file for bankruptcy, and I'll talk about these a little bit more in a minute. Car title loans, which are somewhat newer loan product, not in as many states, so you may not be familiar with them. This slide here, we developed this way because we talk about a car. You get a car title loan and you might as well kiss your car goodbye. One of my colleagues came up with the kisses all over the car. It's a clever graphic. These loans can be made to borrowers who do not have a bank account. To get a payday loan, you have to have a bank account. Payday loans do not go to the unbanked. But to get a car title loan, you don't have to have a bank account because you're sitting on an asset of a car that has value, and they're going to hold the title to your car while they have the lien against it for your car title loan. This slide is based on research that we did at the Center for Responsible Lending several years ago, looking at sort of the typical cost of a car title loan. This had not really been done before. And just in a nutshell, there are a lot of numbers on that page, but in a nutshell, the loans are 300% annual percentage rate loans. They're typically a month-long balloon loan, on average flipped 8 times. And so the borrower who borrows a little over $1,000, based on a car worth $4,000, pays a lot of money in fees every month, does that 8 more times on average. So on average, they're paying over $2,300 in fees alone, and then of course you go back to principal borrowed. So a $1,000 payday loan would cost you $3,391 to pay off under the typical scenario. That is what the typical car title borrower pays. Obviously extremely expensive and also extremely dangerous, because if you fall behind, they can repossess your car. And they're making a 300% loan when they're holding, the title to a car that's worth 4 times what they lent you. it is an absurd arrangement for the borrower. Here is just a little bit more, some quick facts. 75% of the payday revenue comes from borrowers that are trapped in 10 loans or over 10 loans a year. That lets you know that the lenders are dependent on the debt trap business model. Car title lenders typically refinance 8 times, as we said in the previous slide. 1 out of 5 car title borrowers lose their car to repossession. Their cars are repossessed. Sometimes they can get the car back, but that's with an extreme cost. Thus the tissue car goodbye scenario. For consequences, I already mentioned the ones that are on this slide, but I'd like to just mention briefly some of the things I saw in North Carolina. We had payday loans on the ground in North Carolina from 1997 until 2006. During that time, I got calls regularly from people stuck in the debt trap with payday loans, not knowing what on earth to do, because they designed the loan so that if you default on the loan, it's more expensive because of all the bank fees and overdraft fees than it would be to just continue to flip the loan. It's sort of a very smart scenario they've arranged. But I talked to people who literally quit buying food for their family, quit buying gas for their car, couldn't turn on the lights in the house because they couldn't really afford the electrical bill, couldn't pay their phone bill, got their phone disconnected, fell behind on their rent. The first person I talked to was paying half of her Social Security income just in the payday rollover fees. She was evicted, we believe. We lost track of her and could never find her again, and fell behind on their mortgage. We talked to people who couldn't cure default on their mortgage because their debt-to-income ratio was so high, they owed so much money every month to the payday lender. And we talked to people who lost the opportunity to buy a home from Habitat or other good nonprofit lenders where they had a very good possibility of home ownership, but they lost that possibility again because of the debt-to-income ratio. So the impacts of these loans, they're tiny little loans, but the impact is huge and devastating. So this, we looked cumulatively. I've talked a little bit about sort of the borrower impact for these terrible loans. We've also looked through our Center for Responsible Lending research at the cumulative cost of payday lending and car title loans combined. And if you live in a state where payday or car title is legal, consumers in your state are having $8 billion every year drained from their pockets just to pay the fees on these 300 to 400% loans. $8 billion with a B dollars every year, year after year after year. This is devastating. It's an overall economic impact in our country. Now, there are a number of states that don't allow payday lending and or don't allow car title lending, such as we are now in North Carolina where I sit. And in our states, 15 states in the District of Columbia, and some other states that don't allow car title lending, those don't allow payday lending, and other states don't allow car title lending. Consumers in our state, by not having these two loan products, are saving $5 billion in fees saved. So that is money in their pockets that comes from having these loan products off the streets. And it's a huge savings. And I'll tell you that from the time we had payday lending here to the time we lost it, there's nobody in this state that wants to bring this product back. We've never had car title here. So this map sort of shows you graphically, when I mentioned before that there are 15 states in the District of Columbia that do not allow payday lending because they have strong interest rate caps in their state laws. The light yellow states here are the ones that are payday free. The ones that are saving, for the payday portion of the savings, it's $2.2 billion. The car title portion of savings, which is a different chart, is $2.8 billion. But $2.2 billion saved in these yellow states alone. The lighter green states have some protections. The darker green states really have no protections against payday, and that's where the fee drain is coming from both of those states. So now to the rule, which is probably why you called in. You know, we've talked about the problems and the cost of these loan products. Now we want to talk about what we're expecting with the national payday rule, and then what the fallout of that is at the state level. So again, as I said, you know, we fully expected to have the final rule out by the time we did this webinar, and I apologize for that not being the case. But we're still going to talk about, you know, what did the proposed rule say? What do we think about that? What are we anticipating for the final rule? And what do we think is going to happen once the final rule is actually released? What are the payday lenders going to do? What's going to happen? What can you expect to happen in your states? So an important, probably the most important thing to realize about the CFPB's proposed rule is that the CFPB cannot set a national interest rate cap. It's not allowed to. So that was part of the authorizing statute with the Dodd-Frank Act. And it's somebody, a little bit of a funny call here. That shouldn't be coming on my line, but I'm just going to continue and hope we're okay. Can people hear all right? Are you okay, Rita?
Yes, it's fine.
Okay, great. So, so the easiest and best way to regulate high-cost lending is to set an interest rate cap that is ironclad and doesn't have any loopholes in it. That is the fairest for the lenders and the cleanest for the supervisors and the folks enforcing it, and really, frankly, the best for the borrower. But as I said, the CFPB cannot do that. So, so it's much more complicated for the CFPB to regulate high-cost lending without being able to do that. They put out their first proposal in March of 2015, which was what we sort of call a first look. It was a briefer release where they met with a bunch of stakeholders and came out with a first proposal, which a number of us commented on and made suggestions about ways to strengthen it. Their proposed rule came out June of 2016 and was followed by about a 4-month comment period through early October 2016. And again, probably a number of dozens and dozens and dozens of groups in North Carolina, hundreds of groups signed sign-on letters, dozens also submitted their own comments, and then thousands of people sent individual comments as well, and that's just from North Carolina. So this is the first time that payday lending as an industry would be regulated at the federal level. It's a huge important first step in that respect. And again, it's hard to do, but the CFPB has worked with extensive stakeholders. They have held so many meetings you wouldn't believe it, with industry and advocates and from all across the country. They received about 500,000 comments from consumer advocates alone, and people sort of really wanting a strong regulation, and of course many as well from the industry side. So they have had, about a year to sift through the comments and make a decision about the final rule, which we do expect any day, any week. And Rita and I will let you know as soon as that's out. So with the proposed rule, I'm going to just go over this pretty quickly because it won't be that relevant soon when the final rule is out. But I did want to. It does help understand what we're thinking the final rule is going to be. Again, this was released in June 2016. There are a number of things we liked about the rule and some things that we didn't like. One thing we did like is if you look at the products covered, the rule is very extensive. It covers, high-cost loans. It covers payday loans. It covers what's called direct deposit advance loans, which are really payday loans made by banks. It covers car title loans. It covers certain high-interest installment loans and open-end lines of credit. So it's very comprehensive in terms of what they're trying to cover, which is very important because if you write it too narrowly, it's a useless rule. And then, of course, on the left side, you can see that they designed the rule to have two categories of loans: short-term loans, 45 days or less, and longer-term loans of certain types, sort of more expensive longer-term loans. Not all small consumer loans written over 6 months or a year would be covered. It was only the ones that would have a higher APR. So in addition to broad coverage of products, other things that we liked about the rule were the fact that the rule did an extensive job. CFPB has actually spent a lot of time, a lot of energy doing massive research about payday loans and car title loans, focused a lot on what they can glean about the debt trap and how people are caught in these loans and for how long and why. They've done an excellent job on that, and a lot of that information is referenced in sort of what we call the preamble to the rule, which is an important, public document for all of us to be able to refer to, where you're documenting the harms caused by these loans. That's an important first step. Another thing that we really like is that the loan is really couched in, or the rule, I'm sorry, not the loan, the rule is sort of couched in the assumption of ability to repay. So, you might say that payday loans, they're repaid now, even under the debt trap scenario, but not because people can afford to pay them, because people are sort of coerced and forced to pay them with this, personal check or holding the title to your car over your head. You're going to, that is going to be paid first. But you really can't afford the loan when you look at your income and all your other expenses. It's not an affordable loan, and no loan should be made if the borrower can really not afford to repay it without reborrowing. With payday lending, the only way you can afford to repay that loan is if you borrow again 20 minutes later. So this is a very important approach, and one that, of course, we feel strongly about. The proposed rule also included payment protections, which is trying to protect borrowers from a scenario where they're just going to get massive numbers of overdraft fees because they fall behind on the loan, and then the overdraft fees become a nice profit center for the lender as well. And the payment protections are designed to limit that problem. Strong anti-evasion language is super important because payday lenders are notorious for coming up with creative, crazy products that or tweaks to their underwriting scheme, or something that is really designed to violate the spirit of the rule, but they hope sort of technically get around the provisions. So strong anti-evasion language is very important to say if they just morphed this product to get around the law, it's not going to apply. We're not going to let them do that. And then, very importantly, for states like North Carolina and the states that don't allow payday and or car title, and the proposed rule supported strong state usury caps. It doesn't preempt them. If this rule goes into effect, it's less strong, of course, than our usury caps, because everything is less strong than our usury caps. It's not going to preempt our strong state laws. It leaves them in place, and it not only leaves them in place, but it supports them specifically. And I'll talk in a minute about why that's important. So I just want to talk here about the upper right quadrant. This is, again, the rule is divided between short-term, long-term loans. The proposed rule is divided between short-term, long-term loans. And then the general assumption of ability to repay. But if you see in the upper right-hand box, it says no ability to ability to repay. There is a provision in this proposed rule that basically gives an exemption for 6 payday loans at 400%. we consider this a huge problem. There are some provisions in the proposed rule that would make that not quite exactly what it seems, because it's really two sequences of 3 loans in a row. The principal has to reduce between, loan 1, loan 2, and loan 3. There has to be a cooling off period between the loans, et cetera, et cetera. But it still, unfortunately, has the effect of sanctioning, a certain number of high-cost loans. And then, of course, there's the potential that the borrower goes on and continues to get more loans under, this, under some underwriting criteria where they say that they do meet the ability to repay. So we criticized this strongly, as well as a number of other organizations across the country. We feel like the proposed rule should be stronger in terms of requiring ability to repay for every loan, no exceptions. We also think that the protections in the proposed rule against loan flipping, which is just refinancing the loan repeatedly, are not as strong as we would like to see. And we would love for the CFPB to help payday-free states more easily enforce against illegal loans, people that are coming in from out of state trying to make loans in our state. And this is sort of a legal arrangement for doing that. So again, back to the final rule. When do we expect it? What do we expect? If I had to guess, I would say this will be out in the next couple of weeks. But as you can tell, we've guessed long before. But I think soon, and that's for a variety of reasons. So you can certainly go to the Center for Responsible Lending website and sign up for action alerts, and read it as well, forward things that I send out from the Center for Responsible Lending. Most of what I send out is North Carolina specific, so I'm going to be sure that Rita has materials that are appropriate for a national audience. And we are hearing, unfortunately, that I think it's likely that the loan will only cover short-term loans. The rule will only cover short-term loans. It is this being done for a variety of reasons, which we can talk about later if you want to in the Q&A section. It is harder to design rules that capture the long-term market, but we do, of course, think that if this rule does come out and only covers short-term loans, it's going to be very important that the CFPB goes back and finishes the job in the future and covers long-term loans as well. So if it's just covering short-term loans, what do we think? This is quite different than what we were hoping for, and it's an important thing to think about. I would say that we still strongly believe that this is a very important first step, that we can regulate a huge part of this market. We can disrupt the short-term payday business model. We can rein in short-term abuses, protect millions of customers from getting caught in the short-term debt trap with these balloon loans. We need to do that. We need this rule to go into effect, and then later start working on round 2, which would be covering long-term loans in the future. I would say that we have seen very dangerous long-term loans. So long-term loans can be just as expensive as a short-term loan. So the short-term loan has this balloon of either 2 weeks or a month, obviously less than 45 days with the short-term criteria. Long-term loans can be written for a much longer period. They could be for 6 months or a year or a couple of years. But when a payday lender morphs into and starts introducing a long-term loan product, they're basically, in my mind, just building in the flips of the balloon loans, because the loan isn't saving you any money. I mean, in theory, it's fully amortized. So if you got to the end of your loan period, loan term, in theory, you would have paid it off. But I'll tell you, I've talked to people, we don't have car title lending in North Carolina, but I've talked to people who've taken it in other states as an example, and they'll have a year-long loan from a car title lender, 300% interest, quote unquote fully amortized, they'll get to the end of that year and for some reason they have not paid off that loan. In fact, they have a big balloon payment left. So I don't know, and these are people who, I mean, it's like, we'd have to go case by case, but I think when you're in such an expensive, unaffordable loan, even as an installment product, it's just too easy to fall behind, and then, fees and things snowball. So if we're going to put an end to debt trap lending, we're going to eventually have to go back and deal with the long-term loans. But as I said before, we feel like it's extremely important that the rule soon to be released is not sidetracked by industry opposition. So what I mean by that is, and I'll tell you, the payday lenders have been working for years now to prevent a rule, to prevent the CFPB from overseeing their industry, to frame their messages to act like the CFPB is unreasonable, it's going to put them out of business. They will, no matter what the final rule is, they're going to go ballistic, and they're going to say, this is not fair. We're making, small loans to people who can't get credit anywhere else. And they are going to go to their friends in Congress, and they are going to ask those Congress members to basically introduce what's called a Congressional Review Act resolution. And this is a devastating scenario for us, because not only would a CRA resolution on this specifically payday rule rescind the payday rule, it also, with just a simple majority vote in Congress, it also would prohibit the CFPB from doing any future regulations around payday, card title lending, and high-cost lending. So it stops the current rule and it prevents future rules. It basically says you're out of the business of regulating these industries. We cannot afford to have that happen. That would be devastating. So but that will clearly be their intent. And there have already been CRA resolutions passed to overturn CFPB's prepaid card rule. That did not succeed. The resolutions have a certain window in which they can be passed, and the prepaid card rule resolution to rescind it was not successful. So that rule is still in effect, and we're in the middle now. They'll probably vote next week on a CRA resolution about CFPB's arbitration rule, which is designed to get rid of these terrible mandatory arbitration clauses that basically mean that consumers that have been have had gotten illegal loans and illegal actions can't go to court to remedy that. So we're now in the middle of them trying to roll that back, and there's a lot of interesting political stuff going on about that. There are a number of other bills that have been introduced to either basically get rid of the CFPB overall, defund it, dismantle it, change its structure, take away its powers, as well as bills to specifically roll back, to specifically stop the CFPB's ability to regulate payday lending. And I could talk about those a little bit more going forward. In addition to this congressional push, the payday lenders will take CFPB to court and say this rule should be struck down. That's a nice delay tactic. It's also a tactic in their mind to prevent the rule from ever going into effect, because they can say it's unreasonable and unnecessary, and CFPB should not be doing this rule. And as you can imagine, charging 400%, they've got a lot of money to hang things up in court for quite a while. So back to sort of states and state level action. The most important thing, I would say that the battleground is going to intensify tremendously at the state level. We're going to, in states across the country, there's going to be tremendous pressure with industry coming in, trying to convince our state legislators that we need to roll back interest rate protections. We need to authorize long-term loans because clearly CFPB thought they were fine or they would have regulated them in the first place. So they will use the fact that the CFPB did not, if they don't regulate the long-term loans, which of course we fully expect them not to on this round, the industry will say, these loans are great, they're safe, we should have them in every state because people need access to credit. And it's going to be extremely important for all of us to be working at the state level to protect our usury caps if we have them, to enact usury caps in our states if we don't have them, and to do everything we can to not allow the industry to try to loosen our laws around high-cost lending and long-term loans. So we have already seen the payday and cartel lenders have been pushing for several years now to pass legislation in anticipation of the rule. I think thinking that even if the CFPB did cover long-term rules, it'd be easier for them to figure out ways to operate in that space than otherwise. One thing that is important to know is that the Department of Defense, in 2006, Congress passed protections for active duty military and their family that capped loans at 36%, all in, fees, interest, everything. It's a high cap, it's not low, but it's a strong, important interest rate cap. And even though initially they wrote the rules too loosely, they went back and tightened the rules, and they have really done an excellent job of reining in debt trap loans for active duty military and their families. That should be the model nationally. That's what we want nationally, is a national rate cap that reins in these loans. But in the meantime, we need to be sure we protect what we have at the state level. I know now there's an active bill in Michigan, I know, to try to pass high-cost long-term loan, to authorize high-cost long-term loans. There's a proposal in Florida that's a bad one in Michigan, that's one to kill. In Florida, there's a proposal to put in a rate cap in the Florida Constitution. That would be a great thing. That's being promoted by a number of faith leaders in Florida, and there are actions all over the country. Other people on staff at CRL are involved in much of this work, and we'd be happy to talk to you about it. State basis if you're interested in that. Again, this is the chart, one of the earlier slides, and I think the handouts that Rita is going to share with you afterwards will let you go to the fees saved and fee drain papers to see what's happening in your state, how much money you save if you don't have these products, how much money you pay if you do. And I also wanted to talk briefly about just a couple details of how to get involved going forward. And we can talk about this much more again during our Q&A section. So once the rule is out, within the day, we will post a short analysis of it on our website. So if you go to responsiblelending.org and look for CFPB payday rule, we'll come up with, I'm sure it'll be on our homepage. It'll be the biggest thing going. We will also be sending out updates and action alerts and analyses of the final rule. Rita will be sharing those as well. And I encourage everyone on this call, if you are not already working with other groups in your state to defend and strengthen your state laws, I encourage you to start doing so. And if you want to send me an email and ask me, I don't know anybody in my state who else is working on this, please do send that to Rita or send that directly to me, and we'd be glad to find people that you can contact in your state. So with the CRA resolution problem, it's going to be incredibly important that we pressure our Congress members from our state delegations to oppose this resolution, and also to oppose other bills that weaken the payday rule, weaken its enforcement, or dismantle CFPB in a broader sense. We need to be sure that people in our state know who's voted for their constituents, who hasn't. We need to call out people who have voted the wrong way publicly in town hall meetings, with tweets, with op-eds. We've had some fabulous op-eds in North Carolina around some of our bad votes here. So we need to be sure that people understand whether their elected officials are voting with the interest of payday lenders or voting with the interest of their consumers and their constituents in mind. There will be sign-on letters that organizations can join. They're not so much for individuals, but they're usually organizational sign-ons, state level, federal level letters, as well as there is also a push for a national interest rate cap, which, as I said before, is sort of the end game on this issue, but a little hard to see the political path for that at the moment. When the rule is released, we're going to repurpose. We had a portal during the comment period where people could go in and send comments directly to the CFPB, and we're going to repurpose that portal to have it be an action location where people can go in and send messages or get call prompts for their members of Congress, and we will share that link as soon as it's developed and live. And I will say the thing we have going for us in all of this work is that voters strongly oppose payday, card title, and other forms of high-cost lending, overwhelmingly. So when you do polling of likely voters, you're going to come up, no matter who what demographic you're looking at, whether you're looking at women, men, by income, by race, by religious affiliation, by political party affiliation, across the board, people think these loans are wrong, and they think that the government should strongly regulate against these loans. This has been particularly evident in not every state allows it, but some states allow it, and some states you can afford to do it, have ballot measures. In South Dakota, for instance, in the last election, they voted to basically cap loans at a interest rate that would make payday loans illegal in their state and card title loans illegal in their state. And it was an overwhelming vote. It wasn't even close. And, and that's a state that went Republican overall. So I know that this is reading as a handout that relates to this research. So it's probably better to use your handout. And I am going to close down my slideshow and turn back to Rita, who will start our Q&A section. Sorry, I'm sort of having a hard time getting to that, but there we go. Okay. So Rita, I will send this back to you to change presenter.
Did you turn it over to me already?
I am right now.
Okay.
You got it?
Okay.
Okay.
We do seem to have a lot of questions coming in, so I'll do this part really quickly, and then we'll get to the Q&A and the handouts. I just wanted to point out to those of you who are new to financial support again that we offer the certification. It's 5 workbooks. Our students have 6 months to complete it. It is self-study and self-paced and includes 20 CEUs from NASW National. You can also see there that financial social work is in Hong Kong. It's in Wikipedia. It's in the online encyclopedia of social work. So we're very proud of those accomplishments. I'd like to ask all of you to save this date next month. We will be celebrating our 20th anniversary in financial social work, and everyone is going to get a free gift who attends. So that's Thursday, October 19th, 2017. You can claim your handouts if you look at the rectangle at the top right corner. There are two handouts. Susan has some great information for you. And we included this predatory installment lending in 2017, and you can look at it state by state. So you should be able to pull those right out of the handout section. And here is Susan's contact information and ours. And now I am going to go ahead and open the question box and see how much time we have to answer a lot of these questions. Susan, someone named Lisa Terry said hello to you. Okay, so someone asked, have you looked at any online lending fees in those states that are payday lending free? I've heard consumers are going online to get the loans and are losing the protections by the state. She's wondering how true that is. Very interesting.
That is, can y'all hear me? So, am I still on?
To make the loans online.
Yes, yes. Interestingly, Pew has done some research about this issue, and what they found, which I think actually makes sense, is that online lending is higher in states that allow storefront lending than in states that don't. And that there's no increase in online lending when payday lenders leave a state. Now, that's not to say there are not some problems with online lending. There are. And a national rule is a great way to address, some of those larger problems. But I would say that the online lenders have had some strategies that they've played for a while, like affiliating with Native American tribes, saying they're claiming tribal immunity. The federal government and state governments can't touch them, and they have not. The courts are, as these cases roll through the courts, they're ruling against them. So I would say we are definitely not going to make the online lending situation worse by either shutting down payday lending at the state level or by reducing abusive lending at the federal level. It will only help.
Thank you, Susan. Actually, there's a lot of comments, but that really seems to be the only question. If anyone else has a question, go ahead and send it right over. I would like to point out that I think that the Consumer Financial Protection Bureau is the best thing that ever happened to consumers in this country, and if there's anything you can do to protect it, I would encourage you to do so. Okay, here's a question. Maryland is showing as a state that has a cap that would prevent payday lending. However, WeFixMoney.com advertises heavily in Maryland. What can be done about that?
It's interesting because Maryland has in the past been one of the states that has been, I presume WeFixMoney.com is operating online. Is that correct? I'm assuming that?
I'm guessing that because
so the thing I would do, if there's a lender operating online, advertising in your state for loans that are illegal in your state, and as I said really early on in the presentation, I think that people probably didn't tune into this fact, but we did say that one of the things we felt like was important with a proposed rule, and then of course the final rule, is for the CFPB to do everything it can to help us enforce against illegal loans in states that are payday and or car title free. So I would file a complaint with the Attorney General's office, the State Attorney General's office, and I would file a complaint with the Consumer Financial Protection Bureau. In North Carolina, if someone's making an online loan, actually they just took a big enforcement action against some car title lenders that were operating online in North Carolina, which is really amazing because that was sort of we thought that car title lending online was an unusual product. You got to see the car and all that, but they were doing it. And our AG just cracked down on those lenders, and they also send cease and desist orders to anyone who's making illegal online loans to North Carolina consumers. And they also advise the consumers that they shouldn't repay the loan, that they don't, if they've made this illegal loan to them, the consumers, it's with the online operations there, it's hard to know where they are, who they are, what they are. I mean, you're basically going to have to sort of, in some cases, shut down their access to your bank account, and then they're going to come back and try to act like they're going to harass you to try to make you pay. But when you've got your state attorney general saying no, don't pay them anything, then it emboldens the consumer to hold tight and ignore their debt collection attempts.
The person that asked that question also said that there was a phone number, but I think that really just ties in with the fact it's probably an 800 number, and it probably isn't legal in Maryland.
No, it doesn't matter whether if they're making a loan that's illegal under the Maryland laws, that loan is illegal. And they'll try to do it. I mean, there's no doubt about that, but you don't make these other loans legal for the sake of, the fact that you're still having trouble enforcing against some of the illegal lenders. We just have to work to continue enforcing against the illegal lenders. And I would say that that's going our way, not theirs.
Susan, is one of those handouts, does one of them, the link, connect with that map? People are asking about the map, getting that copy of the map.
No, but I'd be glad to send it to you as an attachment so you could share it with the group. We haven't redone, the map that I showed is for payday lending. We haven't redone our car title map because a couple states like South Dakota made car title loans illegal, and we haven't updated that map yet. And New Hampshire had a tweak in their laws as well. But yes, I will send you that, and we could add that to the handouts that are available. Does that make sense, Rita?
We do our best, absolutely.
Okay, I'll send it to you as a standalone attachment as soon as we get off.
Okay. Well, I think everyone would agree with me. Certainly, we have some emails coming in or some comments coming in that this was, a great webinar. And I know I want to thank you so much, Susan. Do you know it was exactly 4 years ago that we did our first predatory payday lending webinar?
No.
And maybe we won't wait so long once this we'll have to see. Thank you, Susan.
Well, we hope, yes. And some things have gone well in those 4 years, and a few others maybe not. But
well, and we do what we can. I just want to mention to everyone that you all will receive a copy of the recording of the webinar. We don't share the slides, but you will receive the recording, so you can go through that. You should have that sometime next week. Thank you, everyone. I hope you'll stay with our community and grow with us and join us next month to celebrate 20 years of financial social work. Susan, thanks again.
Thank you, Rita. I appreciate it.
Have a beautiful rest of the day, everybody.
You too.